There are two routes that you can take when figuring out when to invest, and the first one is dollar cost averaging. Dollar cost averaging is the idea of recurrently investing a fixed amount of money regardless of the cost of the investment. What this is meant to do is lower the risk of buying at the wrong time and reducing the impact of market volatility on your stock price. With this strategy, you're buying the same amount of stock every so often. This can line up with payday, it can be once a week, once a day, or even once a month. By taking this approach, you have a few advantages over the other strategies. By dollar cost averaging and investing on a set schedule, knowing when you're going to have money and knowing when you're going to invest, it allows you to completely automate your investments. This makes it easy to automate your investments, focus on paying yourself first, and removing the resistance when it comes to investing. By investing into the market on a recurring schedule that you set, it takes out the emotion and the human element of trying to time the market at the perfect time, which we all know is practically impossible no matter who you are. With DCA or dollar cost averaging, no matter what the stock price is, you're buying as long as it follows your schedule. If the stock price is up, you're buying. If the stock price is down, you're buying. This way you don't have to pay attention to the price, and it allows the highs to balance out the lows. But let's look at an example on how dollar cost averaging works. Let's say you have $2,000 and you want to invest every 2 weeks over the course of a month. The first time you buy, the stock is $1,000. You buy one stock at the cost of $1,000. The next time it comes around, that stock falls to $700. You can either look at this as, wow, I just lost $300, what am I going to do? Or you can just ignore the price, see that it's on sale, buy again, and average your cost out. This way, when you buy your second stock at $700, you now own two stocks for $1,700. Your cost went from $1,000 to $850. And over the course of your investing career, this is going to go up and it's going to go down and balance out that cost. Dollar cost averaging is probably the more common strategy when it comes to investing, because it really takes the element of timing the market out and it kind of feels safer. Feels safer, yes, key word. It feels safer because you're risking less money, but you are still going to experience the same ups and downs that you will with other strategies. You're probably dollar cost averaging and you don't even realize it. If you're enrolled into your company's 401k plan, this is basically dollar cost averaging at its finest. Every 2 weeks or every time you get paid, a certain amount of money or a certain percentage of your paycheck goes into a certain investment. The next strategy on when to buy investments in the stock market is lump sum investing. Lump sum investing is the idea of just throwing all your money into the stock market at once rather than spreading it out throughout the years. It's basically the exact opposite of dollar cost averaging. Dollar cost averaging, you spread it out. Lump sum investing, you throw it all in at once. This is what people expect to do when they hit you with the classic line,
I'm just waiting for the stock market to crash. I'll invest when it hits that bottom part.
trying to time the market. But this is really the biggest issue with lump sum investing, is it allows you to have that human element and try to time the market, which could be very, very dangerous at times by missing out on your gains. Sitting on the sidelines waiting for the stock market to crash is the easiest way to miss out on gains, because honestly no one knows when the stock market is going to crash or what's going to happen to the stock market next year or the year after. And if they tell you they do, they're lying. When it comes to lump sum investing, you want to make sure that you're not falling into this trap of trying to time the market. Don't try to wait for the perfect time, because there never will be a perfect time. If you follow this strategy, make sure to invest it when you have it, because time in the market is always better than trying to time the market. And that's because it starts the snowball effect earlier and allows your money to grow for longer. And to show the impact of trying to time the market and maybe missing some of the top days, let's see what would have happened. Since we invest, we bought this time machine that's going to allow us to go back to the year 2002. In 2002, we put $10,000 into the market or an S&P index fund and allowed it to grow for 20 years. If you were to let it grow for those 20 years, your investment would be close to $62,000. Let's say you missed the top 10 days. That investment will fall to $28,000. If we missed the top 20 days, that would be closer to $17,000. And if we missed the top 40 days, you would actually be at a negative balance of $7,372. So if you invested 6,960 days and only took it out for 40 days, you would actually lose money. This goes to show that it's not about finding the perfect dip, because that's irrelevant. What's relevant is putting your money into the market and letting it grow and letting the snowball effect take place. One thing about lump sum investing is if it is right before a bull market, you are going to get your investments at a lower cost. But which one is actually better, lump sum or dollar cost averaging? Now let's say you got an inheritance from your parents, or you got a bonus at work, or you just found $100,000 in between your couch cushions. Should you dollar cost average it, or should you just throw it into the market? Well, according to a study done by Vanguard, they actually saw that lump sum investing outperforms dollar cost averaging 68% of the time. This came as a shock to me, because I thought if you're putting it all at once and you catch it at the wrong time, you're just going to be stuck with a high cost. But looking at the market's performance over the last 10 years, it's basically gone up and up and up. So if you lump sum at the beginning, you got it at practically the lowest cost it has been in the last 10 years. No, I'm not saying that stocks only go up. I'm just saying over the last 10 years, That's basically what they've done. In the future, I have no idea what's going to happen. If you were to take the other route over the last 10 years, you're going to dollar cost average and your costs would have just got higher and higher, and you would have also missed out on some dividend payments throughout the years. Since all your money isn't all invested, you're not going to be maximizing your dividend payouts. If you were to throw $100,000 into a 5% dividend stock, you would get $5,000 throughout the year. But if you were to spread out that money throughout the year, you're not going to get the total $5,000 because you are missing out on some dividends. So from a returns perspective, lump sum investing is actually better performing than dollar cost averaging. But that's over just a course of history. But returns isn't what everyone is prioritizing. Some people just want a peace of mind. When you dollar cost average, you reduce your risk to market volatility. And another thing is lump sum investing outperformed in a bull market, but in a bear market where we see downfall of stocks, dollar cost averaging makes more sense because you're lowering your cost rather than hiring your costs. Another thing about dollar cost averaging is it's a lot easy to swallow. If I'm given $100,000 as a first-time investor, it's going to be hard to throw all my money into the stock market. With dollar cost averaging, you can ease your way into the stock market, you can see how it performs, and you can spread out your investments over the course of a year, 2, or even 10 years if you choose to. So depending on your risk tolerance, your priorities, and how comfortable you are with investing, lump sum investing will likely give you better returns in the long run, but dollar cost averaging may be easier to start off with. So if you know which route you're taking but you don't know what to invest in, watch this video next.